Hello and welcome to another insightful edition of Investment Acorns. This is our exclusive series featuring thought leadership from fund managers at White Oak Capital Asset Management Limited. Joining me today is Manuj Jain. He's co-head product and strategies at White Oak Capital AMC. Welcome, Manuj.
Thank you so much.
Manuj has authored two very interesting columns in September issues of both Wealth Insight and Mutual Fund Insight, and we'll delve deeper into them with him today. Now, let's begin with your column, Chemistry of Investing in Mutual Fund Insight. You've drawn an intriguing comparison between chemistry and investing, particularly in how different asset classes, they combine like elements in a chemical reaction. So could you start by explaining how this analogy can help investors gauge or better grasp multi-asset allocation, the concept of multi-asset allocation?
In that article, basically, we tried to explain with a simple analogy. We all know that we have read in school also that when you combine two element or two atom of hydrogen with one atom of oxygen, we come to a chemical formula of H2O, which is nothing but water. But if you add one more element of oxygen, it becomes H2O2, which is hydrogen peroxide, which is basically antiseptic.
Right.
So water, if you don't drink water, you will die. And antiseptic, if you drink antiseptic, you will die. So by changing only small proportion of same element, adding slightly more percentage of that element, change the entire composition. The same is true for many asset classes. All these asset classes have various degree of correlation with each other. We can use this correlation to achieve an optimal outcome. The optimal outcome can be you want to achieve certain level of risk, which is measured as volatility, and certain level of reasonable return. So by using this correlation, we can achieve a right mix of various asset classes, which can help us achieve our desired level of return for desired level of volatility. So that is the whole idea behind that column.
Okay. Now, in your column, you also mentioned that adding a bit of equity to a debt bond portfolio, that can help achieve better risk-adjusted returns. Can you elaborate more on this?
You see, when we talk to many investors, generally it is believed that equity is volatile, which is true, by the way. Equity as compared to any bond portfolio is highly volatile. Obviously, over the long period of time, equity has the capability of generating very reasonable return as compared to debt. So debt is very stable, but returns are very moderate. Equity can deliver very good return, but it is very volatile in the short term. So it is believed that if you are allocating some part of your wealth in equity, you are adding a volatility. Okay, but that may not be true always. So in that article itself, we have mentioned that when you add small amount of equity, let's say instead of putting 100% of your assets in bond portfolio, if you make a combination of 90% bond and 10% equity, by adding 10% equity, actually the annual volatility goes down. And that is because the correlation between these two asset classes are not perfectly correlated. Similarly, you can achieve similar level of volatility which a 100% bond portfolio will otherwise deliver by adding, let's say, 20-25% equity. So by adding about 20-25% equity in your existing bond portfolio, you can achieve almost similar level of annual volatility which a bond portfolio will deliver, but your return goes up by almost 3 to 4% annually on an average, on a long period average. So again, you are using the chemistry of these asset classes, that how they react with each other. And here the objective, let's say in this example, is that you want to achieve almost similar level of volatility on an annual basis. You don't want to compromise on volatility part, but you want to enhance your return. So by adding 25% equity, you are enhancing return without compromising on the volatility part.
Coming to another asset class, gold often plays a unique role in multi-asset portfolios due to its negative correlation with other asset classes. So in today's economic conditions, with such uncertainties, how should investors be viewing gold as a part of their multi-asset portfolio?
So you rightly said that gold has a negative correlation with most of the asset classes. We also know gold is a good hedge against inflation over the long period of time. It has the capability of beating inflation over the time. But what makes gold very interesting from the perspective of multi-asset allocation portfolio is that it has negative correlation with most of the asset classes, for example, equity. And in times when there is too much uncertainty, usually equity market doesn't do well, but gold do very well because again it is regarded as a safe haven. So if you add, let's say we were discussing about this portfolio, instead of keeping 100% in bond, if you keep, let's say, 75% in bond, 25% equity, you can achieve similar level of volatility, but your return goes up by a few percentage point on an average. Now, if you add gold in this portfolio, let's add another third asset class, and let's make a combination of 55% bond now, 25% equity, another 20% gold. Okay, if this is the combination, again, if you do an analysis of last 24 years data, with this portfolio, you can achieve almost similar level of volatility, which a 100% bond portfolio will otherwise deliver on an annual basis, but your return goes up by another couple of percentage. Gold is a very unique asset class. When you look this asset class in isolation, so you may feel disappointed that this asset class is generating, okay, slightly better return than inflation. Equity is a better asset class, but if you use this correlation matrix, given the fact it is negative correlated with most of the asset classes, you can use this asset class to reduce volatility, or you can use this asset class to keep volatility intact and help increasing return for the overall portfolio.
All right. Now, you also pointed out that tax optimization can sometimes lead to suboptimal asset allocation. So, what would you say to investors who tend to prioritize tax efficiency over more diversified portfolios?
So, definitely, first of all, I have a strong view that you should make all the efforts to minimize your tax liability in a legal way.
Right.
Earlier, what used to happen that, as you are aware, a few years back, equity used to be tax-free. Okay, a few years back now, long-term capital gain has been introduced. So now, both whether you are entering in a multi-asset allocation fund, let's say, which has an equity taxation, or you are entering in a multi-asset allocation fund, which typically keep, let's say, 35% plus in equity-related instrument. So both these structures are now tax efficient. In equity, after 1 year, gains are categorized as long-term capital gain tax, and you have to pay, let's say, 12.5% plus surcharge and cess. Whereas in second structure, whereby you only buying, let's say, more than 35% in equity, again, after 2 years, you have to pay 12.5%, okay, tax. So first of all, tax, considering you are investing for more than 2 years, is same, almost same. Now, earlier, because people have this habit that I want to give equity taxation, so if this is the criteria that I will invest minimum 65% in equity at all point of time, which means you will allocate, let's say, anything between 65 to 70%, so that you ensure that at all point of time, the equity is minimum 65%. Now, in multi-asset allocation category, what regulation says is that you have to invest minimum 10% in at least 3 asset classes. Let's say these 3 asset classes are bond, equity, and gold. So if you have already invested 70% and that is your minimum threshold, now you have to add another 10-12% debt and another 10% gold. So you are left with only 7-8% of your asset to take benefit of these correlation, or at some point of time if there's too much uncertainty. So let's take an example. You have 70% equity in your portfolio, 20% debt and 10% gold. And there's too much uncertainty, like take example of COVID. During 2020, let's say at the end of financial year 2020, equity market was down by almost 30% in last 1 year. Gold was up by 25-30% in that financial year. But most of the multi-asset allocation fund were also down meaningfully. Because if you have 70% equity and only 10% gold, 10% gold cannot provide you the stability you are looking for.
Right.
But on the contrary, let's say you have a portfolio which has, let's say, 30-35% equity and another 20% gold. Equity is down by, let's say, 25%, gold is up by 20%, 25%. And you have another 50% parked in debt, which is earning, let's say, anything, for the ease of understanding, 7% return. So now this portfolio will react very differently in this scenario, because gold will be able to protect a lot of downside from the equity market. So what I'm trying to say is that when you work with this precondition that minimum 70%, 65 to 70% has to be in equity, you cannot take benefit of this chemistry. For this chemistry to work, and like you rightly said, that market around the world are very dynamic. So to take advantage of developing situation and scenarios, you need to have flexibility, you need to focus first on the right mix of asset allocation, and then within those parameters, you definitely should try to optimize for tax also. So now there are two kind of structures available in the industry. One, those who are first focusing on equity taxation and then seeing what can be done to reduce volatility. Second structure, which we believe is more optimal way to look at multi-asset allocation strategy, is that you first look at the right combination of these asset classes to achieve the desired outcome. The desired outcome is to achieve certain level of volatility and then enhance reasonable return. This can also be achieved, and this can also be achieved in a very tax efficient manner in the current context.
Okay, but with so many different approaches available to fund managers to manage these funds differently, what key factors should investors keep in mind when choosing the right fund for their portfolio?
I think there are many things which need to be aware of and need to consider while selecting one of these strategies. That first of all, you need to understand what is your end goal. If your goal is to make the highest possible return and you are okay with whatever volatility is there, I think any fund, forget about multi-asset allocation fund, any fund which is equity heavy should over the long term should deliver better return than as compared to any asset allocation strategy with a lot of volatility. But if you are somebody who is okay with reasonable moderate return, but at the same time don't want to see minus 20% in your portfolio on an annual basis, I think then you have to follow, then you have to consider those products and schemes which are using the asset allocation to reduce volatility. And in that context, you have to first look at the underlying structure a particular fund house AMC is following in managing multi-asset allocation fund, and if that structure is marrying with your investment objective or not. So in short, you have to first define what is your investment objective and for how much years you are investing, what is your tolerance level in terms of NAV movement, and then obviously it is a good thing that many structures are available for investor to pick and choose that this structure. So no structure is bad in my opinion. Now it is for investor to decide that which structure is matching their investment objective.
Okay. And to understand that, one should first gauge their risk appetite, you're saying.
100%.
All right. With that, we've reached the end of this conversation. Thank you, Manuj, for taking the time for this conversation. It was great having you.
Thank you so much, Archita.
Thanks.